What
We are
is
now in calculating the components of
it
the
is
business
very
structure.
very simple, very simplest of the simplest thing. What are the
Mm.
components of the capital structure? What are the components? What is the see what you will have when you are doing the things? You will have multiple. You will have equity. You will have preference shares. You have debt, and you have the retained earnings. Okay, there are four different basic components. Is it? You have the debt. You have the preference shares. You have the common stock, you have the additional capital, common capital and retained earning. Is it? Now, whenever you are doing this, it is clearly mentioned the cost of capital from a specific source of finance. What is the cost of debt? Cost of preference shares, cost of equity. Is it cost of debt after tax? Okay, cost of debt after tax, cost of debt, cost of equity, cost of preference shares, cost of retained earnings. If you we because in the capital structure we will have the multiple combinations, different
Yes.
combinations. Okay, the specific source such as bondholders, common stock, is right? Is called as a component of cost of capital. There are various sources out there, including debt, retained earnings, okay, newly issued shares, okay, preference shares, is a newly issued preference shares. Well, what will happen? We should know what is the cost of capital, because ultimately we will why we will do this combination is cost of debt after tax, okay, cost of debt after tax, plus you will have cost of equity, cost of preference shares, okay, plus cost of retained earnings. Is that we will want to measure, is that when we do the things, is that it is like this, you have a graph like this, okay, you have a graph like, when you have the graph we want to know that it will be like this, is that the curve will be like this. We want to know the best combination where the cost of weighted average cost of capital is the lowest.
Mm.
Okay, we use the word optimal. Okay,
Mm.
optimal means lowest. That is what we are
Mm.
saying.
Mm.
Is that the moment there is a change in combination, definitely, and every firm will have its own assumption. There is definitely that is a part of the thing. Whenever you are doing this, what you have to do, you have to take the market values always. This is the
Mm.
one of the conditions. You should not take the book value, market value of debt. Market is when we say market. This is a precondition. Market value of debt, market value of equity shares, market value of preference shares. Is it? We should not take the book values. You have to take the market values. Then only that is the right justification and the application of the rule which is going to be adopted. The calculation of these component costs should be done on after tax basis. This is that we use only where it is applicable after tax. It is applicable cost of debt after tax. Others are after tax only. Okay, others are cost of tax only. Specifically, they will give cost of debt before tax. They will give the tax rate. Okay, they will give the tax rate. Then we have to take cost of debt after tax. For the, and you see very here it has been mentioned, and using market values. Using market values for debt, equity, and they mention very clearly. What they have mentioned, you should
Not book values.
not book values. Okay, not. This is the one of the a basis point. 1% is a. I told you previously we have discussed this. Okay, previously one
Mm.
percent is equal to 100 basis points. Okay, 1% is equal to it is a standard one. Keep this one. We are going to work out in the derivatives in a more specific way. In the
Okay.
derivatives more specific. That is what it says. As if it is increasing from 6.85 to 6.9, it means it is increasing how much? 5 basis points. Now what is there? You have the what are the two conditions we have to take into consideration after tax basis, and we have to take into consideration the market values. Fine?
Fine.
Now, they have given you the things. Okay? This is the same. Now, when you take, we have to take the weighted proportions. Okay, we have to take the weighted proportions. Is that what this is the thing? So how much debt is they prefer? The debt consists of one. They will never give you a direct question as such. I take my word. Never ever give you a. Don't say that they will give like this. They will not. We have to calculate yield. We have to calculate the market price. We have to calculate the tax rate. It will be a multi-stage questions will be there. The debt consists of bonds with a face value. This is the face value. This is the face value. Is how much? They mature in 5 years and a coupon rate. Go see this coupon rate. Payable semi-annually. They were sold 5 years ago at par and have a current value of how much? Current value is 96. 1,000 bonds. Okay, 1,000 bonds of 1,000 each. Now what is the market value? Current market value of 96, which means that 96% of one. Now, if you take 96%, how much it will become? It will become 960,000. Are you clear about this?
Yeah.
Okay, or here mentioned. Sorry, it is they mentioned that the current rate, effective rate of interest is 5%. Is it? The current effective rate of it is. I will not write again. It has been given. Okay, the preferred stock. See the thing. The preferred stock is 12,000 shares. Par value, face value is 25, and a market value is 25.5. The dividend is how much? 4%. That means we have to take the market value. Here is it? Sometimes we are not least concerned whether it is high or low. Whatever the market value is there, that market value is there. The common stock consists of this many shares. This is the number of shares. Par value. They will give you par value. They will give you market value. But consistently we have to take market value. 30%. The stock dividends is 1.25 and expected to grow consistently. Is it? We have done, if you remember, we have done cost of equity with growth, cost of equity without growth, perpetuity we have done. Is that all those rules we have to put it in one segment. The interest rate is how much? 5%. Market rate. The interest rate of 5% is the market rate of bonds for the same term, similar characteristics, not the bonds coupon rate. What is the rate of interest? 5%. The after-tax rate of interest is how much? See the thing. The after-tax cost of debt. The after-tax cost. How much is the 5%? Is it? The interest rate is how much? 5%. At the rate of means we have to take. This is the cost of debt after tax. Okay. Now. Nothing is there. Same thing we have to work it out. Okay. What they say, the annual dividend. This is with respect to cost of debt. Is it? Cost of preference shares, how much? They have given an annual dividend. The cost of a corporation existing preferred stock is the annual dividend divided by D divided by P. Okay, annual cost. This is the cost of preference shares. Okay, cost of what they say, it is going to be dividend divided by the current market price. Okay, now. Okay.
Yeah.
1 minute. How much is the dividend? 4%. Okay, par value is 25. Okay, current market value. Par value is 25 or 1 per share. The market value of is how much? 25.5. Okay, 25.5. What they have said or how they have calculated, we have to be very clear. The cost of preferred stake is how much? How much they are paying dividend? They are paying a dividend of how much? It is the same dividend they are paying. $1. Where is the preference dividends? where is the preference dividends per annum market rate? The annual dividend is 4% of the par value. Is it? The par value is how much? 25. Is that the par value is how much? 25. If the par value is 25, okay, if the par value is 25, is that 25 times 4%, how much you will get? You will get 1. Check 25 in times 4 by 100.
Yeah, 1.
Okay, 25.4 by 100. Okay, the cost of preference shares can be based on the outstanding. Dividend is fine. The number of shares are how much? 12,000 outstanding. 12,000 outstanding means how much they are going to say? The market value of the is 25.5. Total market value outstanding is how much? 25.5 into 306. Is it 306? See, technically speaking, unnecessary they have done this. Whether you are doing like this or you are doing like this, the answer is same. Okay, don't do it. That is the reason I got it. Okay, there is nothing is there. If you are taking like this or you are taking like this, the answer is take any one. Okay, we'll take the simplest one. This is the most simplest one.
Okay.
Okay, now, fine. Now, what we have cost of equity. They have paid the same thing. Pays dividend on the dividend growth model is what is the formula for dividend growth model? Dividend growth model is D by P plus G. Okay, D plus. Now we'll see how they have done. Is that they have done paid dividends of how much? 1.25 per share. Okay, it is expected to grow how much? 4%. Is that this is the dividend D by P. Therefore, the next year dividends is how much? The next year dividend is 1.3. What is the stock value? Stock value is 30 per share. Same thing, nothing is there. Okay, same thing it will be there. See the thing, D by P plus G. Are you clear about this?
Yes.
Okay, D by P plus G. Okay, if you can put in a more clear way. I have put D, you put D1. Okay, now what is the next year dividend? D1 plus P0 plus G. Is it? This is the cost of equity shares. Okay, in separately what we have done? We have taken the individual elements. Based on the individual elements, we have taken the market value, and as per the things, we calculated cost of debt, cost of preference shares, and cost of equity. These are one same. Cost of debt, cost of preference shares, and cost of equity. Are you clear about this?
Yes.
Okay, now. Assess the firm's capital structure. After the component costs are calculated individually, we have to calculate what is the capital structure. What we have to take the weightage. Okay, weightage as a component of total capital. What is the weightage? Total is how much? Total is 3,050,000. You get 3,050,000. Now, what is the percentage of debt in the total capital? Is a total based on the market value. Again, we are saying that we should not take the book values. Here they have mentioned what? Here they have mentioned the book values. Okay, here they have mentioned the book values. We should not take book values. We have to take what? We have to take the market values. Here we have to convert. What is the market value? They say it is 96. 96 is 96%. 96% of 1 million is how much? 960,000. We have taken how much? 960. Okay, 96 is there. Now, what is the preferred stock? Again, 12,000 shares are there. Value of market value is 25.5. We have taken the 306. Common stock, 57,800. Market value is $30. We have taken this. How much we will get? We didn't get 3.5, 3,050,000. We got only 3 million. 3 million. How much we have done? If we take into consideration, okay, 960. 960 divided by 3 million. Okay, 960 divided by 3 million. 306, cross check again, divided by 3 million.
Yeah, I got it.
Okay, 1734. Okay, divided by 3 million. Okay, this is we have to give the weights. Okay, always weights are going to be, if you take into consideration, weights are equal to 100%.
Okay.
Okay, whatever that is, isn't it? Now, once we have taken the weights, is it what is the cost? See, the cost is how much? 0.3. We have calculated the cost of capital individually. Okay, we have calculated the cost of capital individually. 8.33%, 3.9%, 3.25. Is that weight into proportion? Weight times proportion. It comes to cost multiplied by weight. We will get the cost, weighted average cost, and ultimately whatever you will get, that is the weighted average cost of capital. It's very simple. They have made it so big. Okay, they have made it so big. We have to take the sources. Okay, we have to take the sources. One table we can do: key equity, debt, and preferentials. Okay, preferentials. Then we have to take what is the, we will take the market values. Straight away we will take the market values. Then we will take the after tax cost of debt. The after tax cost. Okay. Then we will take the weighted cost. That's all. Is it we have taken? We are not going. So this is the more they have done in a very, very detailed manner. Is that this is the most simplest of the simplest concept. Okay, now.
Okay.
Okay, now what is a marginal? See, existing capital is used to overall weighted capital. When a firm needs to acquire new capital, management, what is the marginal? See what happens, your cost of capital is how much? 6.25%. This is the weighted average cost of capital. Now what happens? This is the benchmark. Is that this is the benchmark? You have to earn more than 6.25. Is that then only what will happen? There will be a positive value. If you are earning less than 6.25, or if you are equal, if you are taking earning 6.25 equal to equal also, it is going to be a break even. Is it? It is going. We have calculated internal rate of return. In the internal rate of return, where the NPV is going to be 0. Okay, this much you have. Now, if the company, if the firm takes new projects, is it? If the firm takes new projects, and if you are taking new project, what is the cost of capital? Or the risk is high, the risk is less, we have to calculate. Is it? The management needs to know the marginal. What is the marginal cost? Is the incremental cost. Is it? In the incremental cost of one additional unit. Thus, the marginal cost is the cost of next amount of capital to be raised. Cost of new capital. Okay, cost of existing cost is 6.25. Now you want to raise additional capital. It all depends on what? It all depends on the risk of the project. Now, you have multiple understandings, okay? You have a very clear multiple understanding. Definitely what the shareholder want that, yes, you are expanding, my returns should be more. That R, this is the value of R. This is the value of R. It talks about risk, it talks about returns also. It talks about, now you are taking additional project. What is the expectations you expect from the management? If you are taking additional project, definitely I want additional returns. But we have to know what is the, if it is a similar business, if it is a new business, If it is within the country, within outside the country, where the projects are there, new technologies. There are so many factors are involved whenever we are thinking in terms of the cost of capital. What is the additional cost of capital for the new one? If the cost of new, it is a cost of new capital. If more than one type of capital is needed, right, the marginal cost is also a weighted cost. Is it? Marginal cost is going to be called as a weighted. See, when you are raising, is that now you need 1 million. Okay, you need another 1 million. Now what you will do? You will distribute this. Okay, you will say that I am going to raise 400,000 from the debt. I am going to issue 200,000 from the preference capital. I am going to use 400 from the equity capital. Is that you have the options, okay? You have the option. Sometimes you will raise total 1 million from the loans or from the debt capital. It is all about, that is not a case of debate. The case of this understanding is what is the cost of the additional capital based on the, again we have to follow again weightage. This is going to be 40%, this is going to be 20%, this is going to be 40%. Okay, the concept of weighted marginal cost of capital is very important in any discussion optimizing the capital structure. Okay, we don't want to raise the cost of capital. Okay, we don't want to raise the cost of capital. How best we can reduce the cost of capital. It is all depends on the situation to situation. As the outstanding financing increases, the weighted capital as weighted average cost of capital and weighted marginal cost of capital will increase. Definitely, if you are taking the additional resources, it will increase. Company presumably have used all. See, when all cheapest sources of finance first. What is the cheapest sources of finance?
Debt.
Debt is the internal retained earnings also one of the forces. I told you there is what I told you. There is a pecking order theory. Okay, there is in the financial management, there is a pecking order theory. What is the pecking order theory? Pecking order theory talks about 3 levels. First, you are talking in terms of retained earnings. So you need funds, you need amount. First, you will search your internal resources. Then, if you don't have, you will go for the loan. If loan is also exhausted, the ultimate option is you will go for an equity. Because going for an additional equity is very expensive. Equity is very expensive by the fact, okay? So we will keep the equity as the last option. Further, as the company has more finance outstanding, the cost of financing, the cost of new financing increases. See what happened, you have a debt, okay, your firm is having a debt. Okay, now you are going for an additional debt. Okay, additional. You talk about additional debt or additional equity. Okay, additional debt, anything. What will happen if I am going to the bank and asking the loan? First, they will see if I am having any previous loan. Is that if I am having any previous loan? If I don't have any previous loan, risk is less. If I am having any previous outstanding loans, then what will happen? The previous outstanding loan, assume the previous outstanding loan is 4%. Now, if I ask for an additional loan, definitely the additional loan will be how much? It will be at the rate of 4.4%. It will be a little bit higher one. Because what will happen? Definitely, if the loan increases, the financial risk will also increase. Okay, that is the reason marginal cost of capital. As the new capital increasing, the marginal capital is also increasing. Isn't it? We have done, isn't it? We have done weighted average cost of capital, but we have not done weighted average weighted marginal cost of capital. Weighted marginal cost of capital, we are doing it for the first time.
Mm.
Are you clear about this?
Yes.
Is it now? This they will give you one tricky question. Okay, one tricky question. If you have done, you will come across, or you will come across whenever you will come. The cost of new capital increases as more capital is from several reasons. Why the cost of new capital is more? An issuer of new securities has flotation cost, such as underwriters' fees for offering new security. Is the issuer of new securities. What they will do, they will say the flotation cost. Okay, such as underwriters' fees. Underwriter, what is the concept of underwriters? Tell me.
To be honest, I'm not sure, but it's the cost of. It's like flotation cost, right?
Yes.
So it is like the cost of issuing debt.
What is
For
the
example.
role of underwriters?
Okay, I'm not sure.
What is the role of underwriters? What underwriters will do?
Mm.
Any idea?
They will see the risk, right?
And
What else? I don't know.
XYZ company. Okay, very simple. Remember this. I will ask you any time at any point of time. XYZ, it is your company. Okay, it is your company. It's a MNC. You are going to issue the capital. Okay, you are going to issue the share capital. Assume you are talking in terms of an IPO. What you will do, you will search the bankers, investment bankers who is going to support you. Okay, investment bankers who is going to support you. Now, you will hit the market when the demand is high. Is that so that you want to sell you are selling product, as simple as that. You are not only selling product, but you are selling the risk. Now what you will do, you approach investment bankers. Most of the banks have the investment banking division. They say if you are really have a good credibility in the market, if you are having a good sound position, promoters, products, all your profile is strong, then what will happen? Assume that a investment banker will say that I will become an underwriter. And underwriter will charge the fees. Okay, it is not as people are there, big JB Morgan Stanley is underwriter, like that. Is it a big Merrill Lynch will be underwriter. You are talking about big banks, okay, big banks. HSBC will be the underwriter, like that. Now, once underwriter is there, is that you are sending a message to the investors that these are my underwriters. What the underwriters will do, underwriters will give you an assurance that if you are selling 2 million shares, if the 2 million shares are not going to be purchased by the investors, anything remaining is there, we will purchase. Okay, we will purchase. That means I am giving you an assurance that yes, I am here. Then what will happen? Investors will see. Investors will not only see the firm but also see who are the underwriters. If the big credible investment bankers are the underwriters, then the investors' confidence will increase. The ultimate thing is whether it is an oversubscription or not. Whenever you will issue the equity shares or any bonds, prefer over subscription should be there. Is that over? Once it is over subscription, definitely the supply is less, the demand has to be more. Okay. For this, underwriters will charge fees. Okay, underwriters will not, good banks, good investment bankers will not become underwriters for each and every company. They will also see the credit profile of the company. Are you clear about this?
Yes.
That is the reason now. But we will cover this in a more detailed way wherever it is going. Is that an issuer of new securities flotation costs such as underwriter fee for offering the new securities to when increasing the total financing cause increased financial leverage. Financial leverage means your debt is increasing more than the equity. The risk to the suppliers of next round of financing will be greater. The risk to the suppliers of the next financing. Okay. See, whenever you see the thing. Whenever you have the debt, okay. Whenever you have the debt, you will have the debt first claim. You will have the first claim. You have the second claim. Okay, you have the second claim. You have the third claim in terms of liquidation. First claim cost of debt is risk is less. Second claim risk is more. Third claim risk is very, very high. Okay. Now, what happens if you are going for an additional finance? Is it right? If you are going for an additional finance, the risk to the suppliers of next financing will be greater. Since the risk is greater, the investors demand higher returns on their investments. I am putting it in another color. Now, if you take into consideration, you can link it. If the risk is high, returns will be high. If the risk is less, returns will be less. You are taking high risk. Okay, you are taking high risk. Is it you are taking high risk? The loans which has been provided or the financing which are provided will have a higher cost of capital. If the cost of capital is high, if the risk is high, is that if the risk is high, you are investing in risky projects, then what will happen? The investors will demand a higher returns. You take lesser risk, okay? That is the reason. Now you see the thing. If the bonds are been, I will tell you again, is that if you have a federal bank bonds, okay? We have a federal bank bonds. What is the risk is less? Treasury, okay? Federal bank is nothing but a treasury. If the treasury is right, you have we call it as a risk-free rate. The rate is less, 3%. But if you are a corporate bonds, the risk is more. Is that the corporate bond, the risk is more. Is that proportionally, when the risk is more, the returns will also be on a higher side. Getting point, yes or no?
Yes.
From economic standpoint, the law of supply and demand provides, okay, little bit, wherever I'm telling you repeatedly this, financial economics, monetary economics, is that political economics. See, these are the things, if you have to be good in economics. Any economics books you come across, read. You will understand. It will be very dry, but you will understand. Economics will give a good understanding about the finance. We call economics as a mother of finance.
Okay. I actually don't like economics.
No. People.
But if you have recommendation to something to read, I will read it.
Read only for reading purpose. See, without economics, we cannot survive. People are there. You cannot imagine. There is one subject called as econometrics. Okay, econometrics. Okay, this is the most demanding subject. Most of the people who are working in the federal bank, senior positions, commercial bank, senior positions. What are the things? All three difficult subjects. You have economics will be very. You will find very few people in this field. Economics will be there. You will have the statistics will be there. Is that they have a mathematics will be there. Genius, they will devise the policies, because they will divide the policies. Finance is only an application. Finance is not that core thing. Finance is only an application. Economics is, it gives you the most important, what they say, the law of supply and demand provides that as the demand for everything increases, the cost will also increases. Financing is a no exception. Is that as the demand increases, what will happen? The demand for financing increases. What will happen? The cost of finance is also increases. As demand for financing increases, as the demand for investment financing increases, the cost of financing also increases.
Okay.
It is a demand and supply. Okay, it is a demand and supply. I will put a small. It is like this. Okay, it is like this. Where is the, yeah? Is that from the? I will put like this. Is that you will have a curve. Okay, you will have, this is the demand curve. Okay, D, and this is the supply line. That this is the demand line. This is the point of equilibrium. Is that this is the point of equilibrium. Now what will happen? Definitely, is that if the demand is increasing, it will become D1. If the demand is decreasing, it will become D minus 1. Is that if the supply is increasing, it is S1. If the supply is decreasing, it is S minus 1. It is more, I will agree totally with you that it is little bit dry subject, but you should know how, at which price you have. See why it happens like this. You have to fix the rate of interest, cost of capital. Is the cost of capital. If the demand is more, the cost supply is less, definitely the cost will be more. Definitely the cost will be more. So we will come across the equilibrium points in different cases. At different points you will get whether the supply is more, whether demand is more. Always you have to judge as a precondition with respect to evaluation of cost of finance. Okay, very important. See, they have given very little. Okay, they have given very little. It is but they have mentioned it. Therefore, each amount or additional amount of financing will be more expensive than previous financing. See, you have taken a personal loan, you have taken a vehicle loan, you are taking in a housing loan. What will happen? Automatically, the bank will see that there is a debt burden ratio. Okay, there is a debt burden ratio, DBR. Different banks calculate in the different ratio, but debt burden. If your debt burden ratio, you have not taken any loan, bank will approve straight away if all the conditions has been satisfied. If you don't have any loan, they immediately, your history will be there. Apart from that, assume you are dealing with different banks. Okay, you are dealing with different banks. What the bank will do? Bank will see your cash flow statement. Okay, cash flows. In the cash flow statement, it is clearly mentioned how much you are paying interest, how much you are paying your loans, whether you have taken the loans or you have given the loans. Cash flow statement. Whenever a firm, a company will submit a loan application to the bank, they will submit the financial statements. Bank will not only they see the income statement and balance sheet, but also they see what is the cash flow statement. It reflects how much, why the bank requires last 6 months, why the bank requires last 5 years. They want to know how much is your income and how much your expenses and what is the If you have taken any loan, what is the amount of loan installments you are paying? That is the only reason bank will ask for last 5 years bank statement for the company or last 6 months for the individual. Are you clear about this?
Yes.
Okay, these are very technical points. Okay, very technical. This is in between lines. Okay, this is not there. This is all in between lines. We have to. Therefore, the firm cost of debt, preferred stock, common stock will all rise as you are using the capital increases. Is it? As the capital increase. What is the difference between a weighted versus marginal average cost of capital versus marginal cost of capital? The weighted average cost of capital is the current overall weighted cost of capital that has already been invested in the assets. Okay, already. Whereas weighted marginal cost of capital is the next amount, future, of new capital when more than one financing source is used for new finance. The weighted average cost of capital is the past. Weighted marginal cost of capital is nothing but what is the new or additional capital which you are using. In the decision situation, weighted marginal cost of capital should be used instead of weighted average cost of capital. See, this is the additional knowledge you are gaining from this concept. What we have gained, that if it is a weighted average cost of capital is the past one, weighted marginal is the new one. Whenever we are going to have the decision making power, we use marginal cost of capital, not for the weighted average, because it is talking about any future investments under consideration. Is it? The weighted average cost of tells the company the cost of current financing of the assets, but the cost of existing capital is irrelevant. What is the weighted average cost of capital? They are talking about the current cost of capital. Is it? Whereas they are not talking about what is going to be the futuristic cost of capital. Once the marginal cost of capital exceeds, once the marginal cost of exceeds the estimated rate of return on potential asset, the company should stop investing, as it would cost of capital to obtain the financing than it expects to return. Now you will compare weighted average cost of capital, weighted marginal cost of capital. Weighted cost of capital is 10%. Weighted marginal cost of capital is 12%. Now, okay, if rate of return, now you are talking in terms of rate of return, means how much you are expecting, okay, how much on potential investment. The marginal cost of capital exceeds the estimated rate of return. Exceeds the rate of return means if rate of return is assumed, rate of return is 10%. Marginal cost of capital is 12%. What they say that the company should stop investing. I will say marginal cost of capital is 12%. Rate of return is 10%. There is no point. You are borrowing at 12% and you are getting a return of 10%. Are we making any wise decisions here in this context? No. Okay, you are borrowing at 12% and you are making an investment of 10%. There is nothing like that. Okay, the company to obtain financing. For example, if the WMCC for a given level of new capital is 12%, it should not invest in any projects which is going to be less than 12%. To do so, it will lose the value.
Yeah. Okay, it's clear.
Okay, it's clear. Simple and it's clear. Are you okay
Yeah,
about
yeah.
this?
Yeah, it's clear.
This is the one of the segments. Okay, this is the one of the segments with respect to what? It is with respect to the cost of capital. Okay, it is with respect to the cost of capital, capital structure, and weighted average cost of capital. A complete segment has been covered till now. Are you clear about this?
Yes.